Imagine if you could check the pulse of India's financial health in real time, not just yearly, not monthly, but every single day. That is what the Reserve Bank of India is promising. But why does this matter to you, to businesses, to policymakers, and to the average citizen? Let's be clear. Financial health is not just a boardroom concern, it shapes inflation, jobs, growth, and even the cost of your next loan. If the financial system sneezes, the whole country catches a cold. With the FCI, India wants to move from guesswork to hard data to monitor financial stress and stability as it happens, not after the fact. This is not just technical jargon for economists. This is about catching crises before they hit your pocket or your job. Who is affected? Everyone. From government planners in Delhi to small-town entrepreneurs to every family with a bank account or a business dream. Why should you care? Because when policy gets reactive instead of proactive, it is the ordinary citizen who pays. RBI's new index could change that if it works as promised. So, what is the Financial Conditions Index, and why is it historic? The RBI announced this initiative in June 2025. The index is designed to monitor the financial health of India's ecosystem in real time, with data updates on a daily basis. Yes, daily. That is a first for India, aligning us with the best global practices, similar to what the US Federal Reserve and the European Central Bank use. Let's get to the nitty-gritty. The FCI is a composite indicator. What does that mean? It pulls data from multiple sources across all major financial segments: money markets, capital markets, government securities, corporate bonds, equity markets, and even the foreign exchange market. These are not just numbers on a screen. Each segment captures a different aspect of the financial system. The FCI aggregates all of this to answer a simple but crucial question: is the financial system tight and stressed, or is it relaxed and flush with money? The historical average for this index is taken from 2012 onwards, providing a robust baseline. The numbers themselves are standardized, so a positive value means tighter financial conditions, think higher interest rates, tougher borrowing, maybe looming trouble, while a negative value signals easier conditions, think cheaper loans, more liquidity, maybe too much risk-taking. And the precision is granular. Values like plus 2.8 or minus 2.1 in standard deviation terms tell you instantly whether conditions are unusually harsh or unusually easy. Why does this composite approach matter? Because single data points mislead. Stock market up. That does not always mean the economy is healthy. Currency strong? Sometimes that just means someone else is weak. The FCI wraps these threads together so policy responses are not shooting in the dark. Let's go beyond the press release. What does this really mean for India's economy, and what are the blind spots? First, who benefits? Policymakers, certainly. RBI and the government get a dashboard that shows stress in the system before it explodes. That is a good thing, in theory. But let's not kid ourselves. Data does not solve problems. Acting on it does. If the FCI signals tightening but policymakers hesitate, the index becomes another ignored warning light. Second, who loses? Frankly, those who thrive in opacity and chaos, bad banks, risky lenders, those betting that regulators will always be behind the curve. A transparent index narrows their playground. But there is a question: what is being ignored? 20 macroeconomic and market-based indicators feed the FCI, but no index is perfect. It will always lag real shocks that happen overnight: a geopolitical crisis, a pandemic, a rogue default. And in India's fragmented market, data quality is a chronic issue. Garbage in, garbage out. Let's look at history for context. Between 2010 and 2014, India was in a period of financial tightening. Why? After the global financial crisis of 2008, stimulus measures ended and tough new rules came in. Non-performing assets spiked, major banking crises erupted, and regulatory tightening reached its peak. According to the FCI model, that period saw values as high as plus 2.8 red zone. Then came the shock of demonetization and GST, further stressing the system. Contrast that with the COVID-19 response. From 2020 onward, RBI pumped liquidity into the system, slashed repo rates, and cut cash reserve ratios. The FCI plummeted to minus 2.1 in June 2021, indicating an era of easy money, but that also meant new risks, asset bubbles, excess speculation, inflation spikes. It is a double-edged sword. The FCI tracks both, but can it predict when the pendulum swings too far? And will policymakers act on these signals or get caught in political paralysis? Globally, central banks rely on similar indices. The difference is in follow-through. When the Federal Reserve sees tightening, it communicates and adjusts quickly. In India, the question is whether the FCI will actually drive nimble, real-world policy action or get lost in bureaucracy. Finally, what are the practical implications? A transparent, real-time FCI helps market participants understand liquidity and systemic risk. For investors, this could mean better risk pricing. For regulators, early warnings. For citizens, more stable growth. But only if data leads to decisions. So, what next? The FCI is a promising tool, but a tool is only as sharp as the hand that wields it. Its value will depend on continuous refinement, robust data, and above all, political will to act on the early warnings it provides. Will it help India spot and tackle the next financial crisis before it spirals? Or will it become another index gathering dust? The answer will define not just policy, but the everyday reality for millions. As India's financial architecture grows more complex, this index could become the difference between timely intervention and costly disaster. Time, as always, will tell. Stay tuned and stay informed.